Is it possible to lose money when you invest in real estate? This is a question that I get asked on a regular basis. A very dangerous assumption that a lot of people have is that you can simply buy any kind of property in any market and that's going to make you rich. Look, I'm going to be completely honest with you. Debt is a double-edged sword, and it can make you a lot of money, but at the same time, it can also lose you your entire life savings. From just talking to my viewers every day, I have heard of so many horror stories when it comes to investing in real estate. And a lot of hard-working people are losing their life savings because they're getting the wrong advice from the wrong people, or they're buying properties from salespeople who just want to get a commission. I have myself lost money investing in real estate. When I first started, I had no idea what I was doing. I made emotional decisions and I didn't do my research. And because of that, I lost a lot of money and I missed out on a lot of great opportunities. So in today's video, I'll be sharing with you some of the different ways that we can lose money investing in real estate, as well as give you some examples of my best and worst deals so you guys can learn from my mistakes. I'm going to share a lot of numbers and figures with you guys. So please don't misunderstand me and think I'm bragging or showing off in any way. I'm not. I'm just being completely transparent with you guys. And please understand that this is not financial advice and I am not a financial advisor. I'm simply sharing with you guys my personal opinions and strategies, and I will always recommend you guys to do your own research and due diligence. Now, let's get started by talking about some of the different ways we can lose money when we buy a property. I know you guys want to learn more about the deals where I've doubled my money in a short period of time, and we will get to that. But for now, we need to address the issue of risk management. Let's start by talking about off-the-plan properties. If you live in Melbourne or Sydney, then the chances are you've probably encountered someone trying to sell you a brand new apartment or an off-the-plan apartment, and they're trying to tell you why it's such a great deal and that you're going to get all this depreciation, you're going to save stamp duty, and it's going to make you rich. Look, I'm not going to lie. Those are definitely some great benefits combined with great affordability. I can understand why first home buyers and first time investors will be attracted to these type of properties, especially with the housing market going crazy at the moment and townhouses and houses in good locations selling for way above reserve. However, let's now go over the reasons why I would never purchase an off-the-plan apartment. When we are buying a property, whether it is an investment or something for us to live in, the only reason we would buy it and not rent it is because we expect the value of that property to go up in the long term. I know what some of you guys are saying. You don't care about capital growth. You just want a place to live in, you want a place to call home because you're sick of renting. But let me show you something that might change your mind. This graph provided by CoreLogic shows the annual change in dwelling values across the different markets of Australia. As you can see, we have seen some crazy growth across our entire property market. The average $500,000 house in Hobart, Darwin, regional New South Wales, regional Tasmania would have made you $100,000 in equity over the last 12 months. That is more than the average Australian salary. But if you own an apartment in Melbourne or Sydney like I do, then you will know that we saw pretty much zero growth in this sector of the property market. In fact, some of these apartments actually went down in value. So why is this happening? Why are these inner city apartment markets so stagnant during a time of high inflation and cheap interest rates? Maybe this picture will help us explain why. If you ever look at the CBD from afar, then all you will see are endless construction cranes building more and more apartments. There is simply too much supply, and the demand has been struggling to keep up for a long time now, even before our borders shut. And even with our borders shut, the construction continues. And these developers are building more and more apartments that is just piling up. And I personally think it could take a very long time for the market to absorb these apartments. With so many apartments all popping up and getting built at the same time, the quality of construction is another issue. We have all heard of Mascot Towers and the Opal Tower in Sydney. If you haven't, then I will strongly encourage you to watch the documentary on 60 Minutes Australia. I'll leave a link in my description. These luxury towers were evacuated when the residents started hearing cracking sounds. The developers have since put millions and millions of dollars repairing these buildings, but in my personal opinion, these apartments are pretty much worthless now. Because who will want to live in an apartment that has made the news for being unsafe to live in? Quoting some of the conversations in the documentary, you have more consumer protection buying a refrigerator than $1 million apartment. And according to the documentary, 85% of all high-rise apartments are defective. Another risk associated with buying an off-the-plan apartment is that you risk the apartment being valued at less than what you paid for it upon settlement. For example, if you paid $600,000 for an off-the-plan apartment and you put down a 20% deposit of $120,000, a year or two later down the track, when the apartment is finally built, the bank can value this apartment at 30 or 40% lower than what you paid for it. This is very dangerous because if the valuation comes back at 30 to 40% lower than what you paid for it, it will mean you have to come up with additional money to fund your deposit, or you can lose your deposit completely. And this happens way more common than you would imagine. And hardworking Australians are losing thousands, tens of thousands, or even hundreds of thousands of dollars by buying these off-the-plan apartments. And this doesn't only happen with apartments, it can also happen with brand new townhouses, as well as new land in new estates. The reason for this is when you buy a brand new apartment, a brand new piece of land in a new estate, a brand new townhouse, or a home and land package, you are paying what's called a developer's premium. This premium includes all the developer's profits, all of their costs, as well as their marketing and the commissions given to the salespeople who sell you these type of properties. I have myself been offered these commissions by these companies many times before to advertise their properties, but I rejected them every single time because I would never recommend something that I would not buy myself. I was talking to a viewer the other day, and he was telling me how he had worked hard for many years to save the $30,000 deposit, which he used to purchase a parcel of land in a new estate. A year later, and after multiple delays, the land was finally ready to be titled. But the only issue was, the bank valued this piece of land at 40% lower than what he paid for it, which means he had to come up with additional money to make up the difference or lose his deposit. Unfortunately, he couldn't come up with the money needed to settle this piece of land, and he actually lost his $30,000 deposit, which was pretty much all he had at the time. This is a very sad story, and it just goes to show how easy it is for you to lose money in real estate if you don't know what you're doing, or if you're given the wrong advice by people who are just trying to make a commission. We are in a major property boom right now, and everything is exploding in value. It is almost hard to lose money right now. But what we should understand is that this property boom is going to end one day. And when the downturn comes, the good investments, where the numbers make sense, are going to hold its value or continue to perform well. But on the other hand, the bad investments are going to cost people a lot of money. So make sure whenever someone tries to sell you a brand new apartment, a brand new townhouse, or a new home and land package, that you do your own research. And don't listen to these people because they're probably just trying to make a commission. Look, I'm not trying to say that all brand new apartments or brand new townhouses or brand new home and land packages are bad deals. There are certainly good ones out there, and I know a lot of people who have made very decent money buying these kind of investments. However, there are also a lot of bad ones. So make sure you do your own research and don't get suckered in by these slick salespeople who promise you the moon. Look, I'm going to be completely honest with you. When I first got into real estate, I had no idea what I was doing. I read some news articles and I watched some videos and I thought this was easy. So for my first purchase, I made an emotional decision and I purchased the inner city apartment in Melbourne. It was in a suburb called Docklands. It was right on the marina and it had these beautiful views overlooking the harbour. My thought process at the time was that, wow, this is really beautiful and this is so close to the city. So all the rich people are going to move here and buy up all the apartments here. And in no time, I'm going to be a millionaire. And I didn't even bother doing my research before buying this property. If I did, I would have found out that this property was sold for the same price I purchased it for more than 20 years ago. I would have also found out that the vacancy rate in Docklands was extremely high, which is a strong indicator of an oversupply of housing. And if I just took the time to walk around and look at what's happening in the surrounding suburbs, then I would have seen the many construction sites building thousands and thousands of apartments that are identical to the one I purchased. And then I started getting the body corporate invoices, which were thousands and thousands of dollars every single year. So once I started putting all of these pieces together, I realized I had made a mistake and this was a bad investment. So I ended up selling this at a small loss a few years later. This was my first and probably my worst investment. So after this very expensive lesson, I decided to learn a bit more about property investing and educate myself so I don't make these kind of mistakes again. After reading all the books behind me, doing a lot of research, I completely changed my strategy. Instead of making emotional decisions based on how good the view is from an apartment, I now focus purely on the numbers, the cash flow, the potential for growth, as well as the redevelopment potential. I'm going to now share with you guys examples of some deals that I'm actually proud of. The main thing that I look for in a good property is good value. So once I identify a market that I think has a lot of potential, then I start networking with the agents in that market and try to get off-market deals. In 2018, I identified Bendigo as a growth hub and I started looking into it more closely. At first, I struggled to find good value, even in a balanced market, because the rental yield was not as strong as some of the other markets that I have purchased in. And I did run into some competition from first-home buyers and other investors. But eventually I found this property in a suburb called Eaglehawk, which back then was considered to be a suburb for people of lower socioeconomic class. But this stood out as a great deal for a number of reasons. First of all, the rental yield was very strong. I was getting $250 a week, which gave me a rental return of more than 6%. The vacancy rate was also very low, meaning I had no issues finding a good tenant. But that wasn't all. What I really liked about this property was the land component. Sitting on a block of more than 1,000 square meters, it had great development potential. If we now look at this property on Google Earth, we can see that it is also walking distance to many local shops, surrounded by other commercial properties. And if we look at what the neighbor has done, they've built 3 townhouses on a very similar block. And with such a big frontage, this property had great residential and commercial redevelopment potential. All of these factors combined with a very strong rental return made it stand out to me as great value. There is no point in reviewing the growth of this property because you guys already know that I am not looking to sell my properties anytime soon. I'm looking to hold my properties for as long as I can, redevelop them, and maybe sell them one day when I'm ready to retire. However, based on how crazy the Bendigo market is right now, I think I can get close to $350,000 for this property. The strategy that I used for this property was a mixture of land banking and high rental returns. But there are other properties in my portfolio that use a very different strategy. I showed you guys this investment in my last video. This was a purchase in a suburb called Mowbray in Launceston. And as you guys can see, the property is only sitting on a land size of 341 square meters. Obviously, this property doesn't have any redevelopment potential, but what it does have is a crazy rental return of more than 7%. It is also a very old property, which means it could do really well with a renovation. And based on my research, if I was to spend maybe $50,000 renovating this property, it would be worth more than $400,000 if I was to sell it. But as you guys already know, I am not looking to sell. Let's now circle back to the topic of brand new and off-the-plan properties. A lot of investors are attracted to brand new properties because of the depreciation and the great tax benefits. This is certainly true. A good investor will take advantage of depreciation and save money on tax. But in my personal opinion, a great investor can create depreciation of their own. So what do I mean by this? Well, instead of buying a brand new apartment or a brand new townhouse and paying the developer's premium, why don't we create our own depreciation by developing ourselves or renovating? For the first example that I used for the property in Eaglehawk, if I was to knock that property down and build townhouses, I'll be able to claim depreciation on all of those townhouses. And for the property in Launceston, if I was to renovate it, I can now claim depreciation on the renovation costs. And all of this is done without paying a hefty premium to the developer. Alright guys, I know this has been a long video, so I'll try to wrap it up quickly. As you guys can see, my investing strategy is probably very different to most people's. I'm not really attracted to brand new townhouses or brand new apartments because I see them as overvalued. I'm going to show you guys some photos of the properties that I'm currently looking at, and you will understand exactly what I mean when I say this. I am definitely not looking for a beautiful home to buy. If I want to live in one, I will just rent it. But I'm instead looking for potential to add value, because that puts profit into your pocket instead of the developers. Alright guys, this brings us to the end of the video. I really want to thank you for watching until the very end. If you got value from this, please do me a huge favor by hitting that like button, sharing this video with your friends. It goes a long way in supporting the channel. I hope you guys stay safe and productive during lockdown, and I will see all of you guys in the next video.